Go.
This is our personal investment presentation for the Investment and Financial Analysis 5016 by myself, Llewelyn and Lewis.
The scenario is we're given £100,000 and we are supposed to invest it in a variety of investments between high risk and low risk. So we've decided to go for 10% in properties, which is low to medium risk, 40% into an ISA allowance, which is low risk, £5,000 into cash, which is low risk, 20,000 into bonds, which is medium to high risk, and 25,000 into stock shares, which is high risk. Yep, so as we said, 10% of the portfolio will be in property, which is relatively low risk. There is 5 main types of properties that you can invest in. Raw land, industrial properties, residential properties, and special use properties. Now, and obviously, we're going to be recommending the commercial properties. So commercial properties are things such as warehouses and offices, and they can provide a steady income to the owner, granted that tenants will be paying to use the buildings. The value of the property will not change on a day-to-day basis, which means they are typically less volatile compared to other investment types, such as stocks and shares. But there are a few risks that are associated with commercial properties. So with these things like properties are less liquid, which means they can take a long time to sell. So if you're looking for a quick bit of cash to take out the portfolio, you cannot take it out quickly and effectively out of properties. And in addition to this, you will need an agent to sell, who obviously they will take a percentage of the total sale amount. If a tenant leaves the property, it can be hard to find another tenant to fill the space that was in the building. And that means obviously while the tenants aren't in the building, it won't be generating an income. Costs associated with maintaining buildings, which includes things like fixing, damages and security costs, things like cameras. And also you have to pay interest on a mortgage if the investor decides to take one out for the remainder of the cost of the property. The tax information, usually generally have to pay stamp duty when first purchasing property or land. Basic rates are as follows: 0% up to 250,000, 5% between 350,000 and £1, and 925,000, which is obviously the next 675,000. 10% between 925,000 and £1 and £1.5 million, and 12% on anything over £1,500. And the effective tax rate will be the percentage amount that you pay of the total price of the property. And obviously, you're obviously subject to net rental income in the form of income tax, as obviously this is an income will count as part of your income.
So the next part will be 40% of the overall £100,000 investment will be into a cash ISA. So with a £40,000 investment into Virgin Money's fixed cash ISA over the course of 2 years with an interest rate of 4.17% and the interest paid quarterly, which is every 3 months, the potential returns are £2,280 at the end of year 1 or £570 quarterly from when the account is open / when the funds are deposited, bringing the total to £42,280 at the end of the first year. In year 2, the total return / interest from the previous closing amount of £42,280 will be £2,409.96 annually or £602.49 quarterly, bringing the closing amount of year 2 to £44,689.96. So with an investment into a fixed cash ISA, there is zero risk involved, there's no tax implications and the interest is paid out to you, meaning it is risk-free investment and you can keep every penny of it. In this case, the interest amount will be £4,689.96 at the end of year 2, which is a 2-year term, which is all profits and zero taxes paid out on it. This doesn't include other types of ISAs, such as an easy access ISA, that may offer lower interest rates depending on the term that the account is open for, but overall, all types of ISAs are risk-free and have zero tax implications.
So next we have the cash reserves, and these can be held in a portfolio typically in the range of 3 to 5% of the total portfolio value. The purpose of this is if a potential investment opportunity presents itself, then the portfolio manager does not have to sell other assets in or to invest. So the pros of cash reserves is that this typically holds the lowest risks within a portfolio. It also earns you interest. Another advantage is that banks must hold large cash reserves in case of the instance of going bust. But the drawbacks of cash reserves is that due to cash typically holding the lowest risk, then it often means that a lower return can be observed. There's also a risk of inflation, as if the inflation rate increases, the value of the cash decreases. There's a counterparty risk, going bust, however cash reserves can decrease the risk. There's an interest rate risk, if interest rates decrease then there will be less return. For tax, you are given a £5,000 interest allowance on any interest paid on savings, known as a starting rate for savings. If you earn more than £17,570, then you are not eligible for this. If you earn under this amount, the difference between your personal allowance and your wage is what your starting rate for savings will be. A personal savings allowance is given up to £1,000 in interest earned on savings, depending on your income tax band. If the interest paid out exceeds all the allowances granted, then the remainder of the interests will be added onto your income and will be taxed as such.
Yep, so the next thing we're going to be talking about is bonds, which holds 20% of the portfolio, which is £20,000. Bonds are debt securities issued by the government or by companies that are given in exchange for money and are a form of loan. There are three main types of bonds, and these being corporate bonds, which are debt securities issued by private and public companies. High yield bonds, which hold a lower credit rating than corporate bonds and therefore more credit risk, and so offer higher return rates in return for higher risk. Municipal bonds, which are bonds issued by states, governments or cities and other government entities as general obligation bonds, revenue bonds or conduit bonds. Now the pros of bonds are bonds pay a certain amount of interest on the money invested in them and typically have higher interest rates compared to cash, which means the return on investment can be higher. Bonds are a diverse choice for a portfolio as they can be issued by governments or companies in the investor's home country or abroad. And again, it's a diverse choice as typically when the price of equities or stocks decrease, the price of bonds typically tends to increase, and obviously that applies both ways. Bonds are typically less volatile than stocks, which means less risk on a day-to-day basis, and they require less attention compared to other investments, which means it's low maintenance. And bonds are considered very liquid investment options as they can be bought and sold with ease. However, if they are sold before maturity, a loss can be observed. And there are some risks associated with bonds as well. If interest rates change, then the money that you earn on invested bonds could become less attractive, and that could cause the demand for bonds to decrease as cash can be seen as a more lucrative option to other investors. The longer that a bond is held for, the more risk it carries due to the changes in interest rates and inflation rates, as I said before. And the more volatile than cash and can greatly change on a day-to-day basis. And if the company that issued bonds goes bust, then the equities will be paid first from the liquidation of the company that the bonds were purchased from. Now, as for some of the tax information, onshore bonds are taxed as part of income, so after dividend income. They benefit from non-reclaimable 20% tax credit, reflecting the fact that the life company will have paid corporation tax on the funds. And offshore bonds are aggregated with all other savings, incomes and tax earned after income but before dividends, as there's no UK tax income on gains within the bonds and there's no credit available to the bondholder. Gains are taxed by 20%, 40% or 45%. Gains will be tax-free if they're covered by an available allowance.
So the next part will be stocks and shares, which is 25% of the portfolio, which is £25,000. Historically, people have made 7 to 10% returns on average, potential high rewards. Holders of the shares can receive both cash dividends and stock dividends, potentially being a lot, depending on how many shares are held and how much the value of the company has risen. Anyone who is able to invest in blue chip stocks such as Amazon, Microsoft and Apple, they're able to cash funds out at any time. There's a dividend allowance of £2,000 each year and a capital gains allowance of £12,300. The cons are that stocks can be very volatile, meaning so you can get returns. The high risk, some stocks can be a long-term investment, which is 5 years plus. They're subject to various tax depending on the amount in profits. So there are various sectors of shares to invest in, some of low risk, some of high risk. An example of a low risk defensive sector of shares is the supermarket industry. It's been notorious to be in a good investment area as people always need to shop and buy groceries. Following the recent cost of living crisis, it has forced shoppers to spend more money on groceries, therefore pushing up the price of the industry, making it an even better investment and sticking to its roots of being a traditional good investment. On average, the supermarket industry gets a 33.5% ROI, which is a very good return, and as it's a stable industry, the returns are not as volatile. On a £25,000 investment with a 33.5% return, you'd have a balance of £33,375 at the end of the first year. And with a capital gains allowance of £12,300, you'd be paying 20% tax on £21,075, which is £4,215, leaving you with a total of £29,160 tax-free excluding dividends. An opposing side to the supermarket industry is the construction industry. It tends to be more volatile, meaning it's a risky investment. However, with the risk can come great rewards. And although the average return for a share such as Vistry Group VTY, which is in the 9.3%, with a £25,000 investment over the course of a year, the returns could be £2,325 at the end of the first year, whereas with the investment was to be carried into the second year, it would turn into £27,325, which would be £22,541.24p, making the final balance of the second year £29,866.24p. The tax implications on this investment will be to pay 20% of £17,566.24p, as there is a capital gains allowance of £12,300. This means that in total you'll be paying £3,513.25p in tax, being left with a total of £26,352.99p tax-free, excluding dividends that may be paid out.
So adding on from the previous slide, this here is the construction sector performance history, and these rates are affected by external factors such as COVID and cost of living crisis, for example. The highest spike of COVID rates occurred in 2020, which resulted in certain industries to benefit financially. The backlash of COVID in 2021 caused a decrease of value in most sectors as the economy mostly struggled. In 2022, the markets recovered to a more stable point, while COVID was less impactful on the markets. But then the cost of living crisis occurred, which doesn't cause the markets to thrive or reach a new high. But when compared to recent years, the return of equity is fairly profitable. In conclusion, we believe that this portfolio has effectively balanced risk, return and volatility using a range of various investment types. Thank you for listening.